If you're anything like I was and you don't understand what stock market is, then this video is for you. In this video, I will simplify what stock market is and give you a basic introduction to stock market and how to invest in stocks. Welcome to the channel. I am AB and thank you very much for watching this video. If you're not subscribed to the channel yet, I would really appreciate if you'd click the subscribe button so that I can share my new videos with you. Stock market can seem like an enigma for a lot of people who don't really understand how it works. For people who don't really understand it, it is a big scary thing which will take away all your money and turn it into nothing. And on the other hand, people have a perception that for people who understand the market, they can actually use it like a magic wand and turn their investment into huge amounts of money and become ultra rich. The thing is, both of this is right. When people see the stock market rising, they invest in the market through either somebody else like a financial institute or a broker, which is always a good idea if you don't really understand the stock market, or stay completely clear out of it. In both the cases, with a lot of people, they don't really understand what stocks are, how stock market works, what causes the prices to go up and down, and if there is actually a strategy that can be learned simply to start investing in the stock market. Let me introduce you to the stock market and let you know about what stocks are, how to invest in stocks, give you a basic understanding what stock market is, and hopefully this will encourage you to learn about stock market and start investing and start multiplying your hard-earned money just like it has done for so many of us. So what is a stock? So in very simple terms, a stock or a share or equity is basically the portion of a company that you own. For example, a company has about 1,000 stocks and you own about 100 stocks of that company or 100 shares of the company. Well, it means that ideally, it means that you own about 10% of the company. But the thing is, in reality, large corporations or companies have millions and millions of stocks. So which means that every share or every stock is actually just a very small portion. So for example, if you want to own 10% of a certain company, you might want to own a huge amount of stocks or shares, which is a lot of times not possible. So for example, if you want to own 10% of Apple or Google or Facebook, I mean, you can't even imagine the amount of money you would need. You would probably need billions and billions of dollars to be able to own something like that. But if you don't have that kind of budget, which I think you might not, you could own a small portion in terms of the stocks or the shares. So every stock or every share that you buy is probably just a 0.00001% of the company. So the more stocks you own, the more shares you own, you get a higher amount of ownership in that particular company. So this basically gets you kind of ownership, part ownership in every company that you invest in. So now, if a share or a stock is an ownership or a partnership that you have with a certain company, why would a company want to sell its stocks? Why would somebody want to get more partners and get co-owners into their company? So let's imagine that you have a company and you have a product or service which is doing pretty well and you're pretty happy about how things are going. Now you realize with this kind of thing, you can only go a certain way, and after that, if you want to diversify, you want to become bigger and larger, you need a lot of investment coming in, because if you don't do that and if you have competitors, they will take advantage of your situation and probably step in and take your position. Now if you want to reach out to more customers, if you want to become bigger, how do you do that? One of the ways of doing that is selling a portion of your company and converting into stocks or shares and selling that on the stock market. Obviously, it is not as simple as that. It's a huge process. You have to be listed on the stock market. You have to come up with an IPO, which is something that is a very, very complicated process. But once you've gone through that and the company is actually listed on let's say one of the stock markets, you can start buying the shares. So every share has a base value that the company decides, and depending on the demand for it, the share prices can go up or come down. It's not just about the demand, it's also about how the company has been performing, how the company is perceived to be, and what kind of future it holds. So if people think and if the market is conducive to it, the shares can really go high and you can reap a huge amount of profits, and the company makes a huge amount of money in that. And adversely, the perception of the company, of the performance of the company, or the product that is introduced is not really working, the prices can go down. A good example of how the prices can go up with a good product is Apple. When towards the beginning of the, let's say, early 2000s, when they introduced the iPod and the iPhones, the shares really zoomed up because the product was a big hit. A lot of people started utilizing and using iPhones and iPads and all the iProducts that they came up with. And this encouraged people to invest more in the company because they thought, okay, this is a good product. The company is really big. The company is really well. The products are fantastic. We love it. And people started investing. And for people who have invested at that early stage in Apple. Now you know the story, obviously. As they say, the rest is history. Apple shares have skyrocketed since then. Just like there is a place to sell any product or service, there is a place to sell and buy stock. And that place is called the stock market. Now, should you be investing in stock? Now, when we look at the stock market, we hear a lot of stories. There are stories about people who've invested all their life savings in the stock market, and the stock market has crashed down and completely ruined them. All their investments have gone and they've actually come off burning their hands and losing all their hard-earned money. Now, on the other hand, you also have people who have invested a lot of money in the stock market at the right time and the right stocks and the right companies, and they have reaped huge benefits and they're actually laughing their way to the bank. If, for example, in the early 2000s, you invested in companies like Google, Facebook, Apple, you would be really happy right now. Now, these are two extremes of the stock market. I mean, you can obviously lose a lot of money or you can gain tens of times of your investment. But is it realistic to be actually expecting some sort of gain without a lot of risk? Well, it entirely depends first on your emotions and your attitude. Like Warren Buffett says, if you're not a very emotionally stable person, you should not invest in stocks. Absolutely, because stock market is about patience. Stock market is about staying put, buying your stocks, staying there for as long as it takes. It's like, let's compare buying stocks like an investment that you make in properties, real estate. You don't expect real estate to actually give you a lot of profit overnight. You don't want to sell your properties or real estate just a couple of weeks down the line, and you don't really check for prices every now and then saying, okay, have the prices really gone up? Should I be selling it? You buy your real estate, you buy your, let's say, a house or a building or whatever you have the capacity to buy, and stay put for a long time. When the time is opportune, when you know that this is the right time to sell it, that is exactly when you sell it. You don't really sell your properties just overnight. It's the same concept for stock market. It's the same concept for stocks that you buy. First of all, obviously, you have to make sure that you're buying the right stocks. And once you've bought the stocks, forget about them. Don't look at them at all. Wait it out. There might be recessions, there might be a lot of things happening, but don't worry about what you've invested in. If you're there for the long run, historically, it has been proven that stock market gives you more return than most other investments that you can make anywhere. So if you have the patience, if you have the emotional stability to actually hold your ground through everything, then that is the right thing for you to do. Then you should get into stock market. But obviously, remember, there is always a risk. So you should always only invest what you can forget. For example, if you invest £100,000 or $100,000, don't think about getting it back in a couple of weeks, 2 weeks, 6 months or whatever. You have to stay put. Now, how do you buy these stocks? It's not like you go to the share market, stock market, and say that you need 10 stocks of Tesla or you need, let's say, X amount of stocks of something else. You can't do that. You need to have a brokerage account or a demat account where you can actually start trading. So you can do this from a broker, you can get this from a broker, or you can get it from a bank which is licensed to actually trade in stocks. So once you have that account, you can start trading. Obviously, there is going to be a small amount of fee that is charged, let's say maybe monthly or per transaction. That is something that you have to actually check and go with the best that you can get. Nowadays, you also have a lot of these apps on your phone that you can download and start trading on the apps as well. So you don't really have to go to the bank or a broker. You can start trading on the apps as well. The next thing that we need to understand is, why do the prices of stock go up or down? Now, there are so many reasons why this could happen, and this could be something like a government policy or a new budget that is good for a certain product or bad for another product, or it could be something that's absolutely on the other end of the world, like a war that's happening or a drought that's affecting, let's say, the production of a certain thing that related to the kind of company that you want to buy the stocks for. It could be a new product that's actually come in the market and is actually taking it up by storm, a new technology that's influencing the kind of companies that you want to invest in. It could be simply a tweet by somebody, or it could be a simple action of taking 2 bottles from the camera and putting it aside. And if that person is really influential, that can affect the prices of the stocks. Now, as you see, most of the things are something that you cannot really control or you can't really foresee. But apart from that, what actually affects the price of the company is the performance of the company. You have to look at what kind of products they have, what kind of future it has, what kind of infrastructure it has. Do you think that the product is going to do well in the future? If it is, then people will have faith in the company, and if people have faith in the company and the product, they will invest more. And if they do that, the value of the company increases, and with the increase in the value of the stock increases. Now, there are only so many stocks. So if there are, let's say, about 100,000 stocks, you can't really suddenly have 200,000 stocks tomorrow. So therefore, if a stock is worth $10 right now, if there is a huge amount of demand for it, and so there's more demand and less supply, obviously the price of that commodity or price of that stock is going to rise. So a $10 stock can become a $15 stock overnight almost sometimes, and which happens really rarely, because 50% increase is like tremendous, but it can happen. And so in short, it is the performance of the company, it is the perceived value of the company and the demand that people have for the company's product and services and the stocks that they have in the market. Obviously, you also have examples of companies which have spent a huge amount of money in product development and have introduced it to the market only to see it fail completely and miserably. When something like that happens, the stock can really go down, and you don't really know what kind of products or services they will come up with. So it is always wise not to keep all your eggs in a single basket, basically, which means that not to invest everything in just one single stock or one single industry. So if you want to invest, you should always have a portfolio of companies from various sectors like IT, automobile, social media, and try and diversify as much as you can. And that will kind of mitigate your risk. And if, let's say, for whatever reason, one company falls down, there are other stocks that you've already bought that will kind of balance things, hopefully, and you will not feel the pain and the pinch of the crash of a certain stock in the market. Of course, choosing the right stock to invest in is not always going to be all that simple. You need to be able to understand what the company is, what its future beholds. You need to understand the technical analysis and fundamental analysis. And there are a lot of things that you need to study before you can actually invest in a certain stock. If you have the time, I would always encourage you to do that. It is really important that you understand the company, you understand the analysis, and you understand the market when you're investing. It is always going to be helpful. But if you are somebody who does not really have the time or does not really have the inclination to learn all these things, there are obviously other ways and avenues of investing in the stocks. Now, two of the most popular ways of doing that is the index fund and the mutual funds. Index funds or mutual funds, well, index funds are kind of mutual funds which invest in the financial market index, something like S&P, and follow them and track them throughout, which means that if the index fund, let's say S&P market is going up, the prices on the index funds will actually go up, and if the S&P is performing poorly, the prices will go down. But over a period of time, we've seen historically this has actually been one of the best ways of investing if you are risk averse. So if you don't really understand the market, if you don't really understand how to select and choose stocks, you can start investing in the index funds, and this will almost surely give you a profit in the long run though. Now, there is an interesting anecdote, there is an interesting story about how Warren Buffett actually made a bet with hedge fund managers, saying that the S&P is, or the index funds are going to perform way better than the kind of hedge funds that these people choose. And they agreed to a $1 million, and over a period of 10 years, they followed the index, and obviously Warren Buffett won the bet. So you see, I mean, instead of choosing individual funds and taking the risk of whether or not this is going to perform well, you can start investing in the index funds and in mutual funds, and over a period of time this will give you a much better profit at a much lower risk than you would do if you were to invest individually in these stocks. So this is one way of doing that, and I would highly encourage you to actually go ahead and choose one of these ways if you don't really understand the market. But as I always say, understand the market, learn about it. Investing is an art, investing is a science, and at the end of the day, it is your money you're investing. It is hard earned. It is really, I mean, everybody loves their money, everybody wants it to grow, but if you don't want to spend time in understanding how it grows, it's not going to go a long way. So instead of blindly following somebody who tells you to invest in a certain stock or in a certain fund or in a certain avenue, if you can understand and learn about finance and investing, it will help you in the long run and will go a long way for you. So that was a basic introduction to stock market and stocks and investing. I hope you enjoyed this. If you did, please like the video and subscribe to the channel so that I can come up with more videos like this where you can start learning more about finance and investing. Thank you very much for watching this, and see you in the next video.